Hey everyone, welcome to the Successful Finance Journey. I'm so excited to have you here. In today's video, we're diving into a topic that has transformed how people invest over the last 2 decades: index funds. Whether you're a beginner or an experienced investor, understanding index funds is a key part of building a smart, diversified portfolio. It is crucial to mention that this video is for informational purposes only and not financial advice. I am simply sharing strategies that have worked for others or that I find useful as I continue on this finance journey. Before making any investment decisions, I recommend doing your own research or consulting with a financial professional to make sure your choices align with your personal financial goals. So, what exactly are index funds? Let's break it down simply. An index fund is a type of investment that aims to mirror the performance of a specific group of stocks, also known as an index. Instead of trying to pick individual stocks, index funds give you access to a broad range of companies, spreading your risk and increasing your chances of getting a good return. It is like buying a basket of different fruits rather than trying to pick individual fruits yourself. Here's a question. What if instead of putting all your money into just Apple or Google, you invested in hundreds of top-performing companies at once? That's where index funds come in. Some well-known market indexes include the S&P 500. You must have heard of this one. It tracks the 500 largest companies in the US, the Dow Jones Industrial Average, tracking 30 blue-chip companies in the US. Thinking of investing in Nigeria? You are not left out. The NGX 30 includes the 30 largest and most liquid companies on the Nigerian Stock Exchange. If you invest in an index fund that tracks the S&P 500, for example, that fund will hold the same stocks that are in the S&P 500 or a sample of them. This gives you instant diversification. Now, index funds come in 2 main types: mutual funds and exchange-traded funds, or ETFs. Let's break down the 2 terms. I know these terms can sound complicated, but they're really not. So let's simplify them for those that are not familiar. A mutual fund is like a big pot of money collected from many people just like you and I, who want to invest. This pot of money is then managed by a professional whose job is to invest it in a variety of companies or other assets according to specific rules. So when you invest in a mutual fund, you're essentially putting your money together with other investors and letting someone else manage it for you. This is great if you don't have time or knowledge to pick stocks yourself. One thing to note is that you can't trade a mutual fund like a stock. You buy it directly from the fund company, and it's typically priced only once a day after the market closes. It's a bit like buying in bulk with a group to save costs. In another video, I shared how much my Stanbic IBTC money market fund paid me. You can go and watch that video. Now, an ETF, or exchange-traded fund, works in a similar way, but with one key difference. You can buy and sell ETFs just like stocks. ETFs are also a collection of investments, but they're traded on the stock exchange throughout the day, meaning the price can change while the market is open. So think of an ETF as a basket of different investments that you can easily buy and sell anytime during market hours, just like you would with individual company shares. This gives you more flexibility than mutual funds. Here's the main takeaway. Mutual funds are like a team effort where your money is pooled with others and managed professionally, but you don't get to buy or sell it during the day. ETFs are a bit more hands-on. You can buy or sell them anytime the market is open, just like individual stocks. To sum it up, both mutual funds and ETFs are great ways to invest in a diversified portfolio without having to manage each investment yourself. Mutual funds are a bit more restricted in terms of when you can buy and sell, while ETFs give you more control because you can trade them throughout the day. Both types are usually passively managed, meaning the fund simply mirrors the performance of the index it tracks. This is what makes them low-cost options for investors. For example, a popular mutual fund in the US is the Vanguard S&P 500 Index Mutual Fund, VFIAX, and a well-known ETF is the Vanguard S&P 500 ETF, VOO. In the UK, A similar option for mutual funds would be the Vanguard UK FTSE All-Share Index Unit Trust. And for ETFs, you have the Vanguard FTSE 100 UCITS ETF, VUC, which tracks the FTSE 100 index. One popular mutual fund in Nigeria is the Stanbic IBTC Money Market Fund. This fund invests in low-risk, short-term financial instruments like treasury bills and bank deposits. It's great for investors looking for stable returns with low risk, which is why it's one of the most widely used funds in the country. Another option is the ARM Discovery Balanced Fund, which offers a blend of stocks, bonds, and other assets, giving you exposure to a variety of investments in a single package. AXA Mansard, Cardinal Stone, and other brothers also offer a mutual fund option. For ETFs, one of the most well-known in Nigeria is the Stanbic IBTC ETF 30. This ETF tracks the performance of the NGX 30 index, which consists of the 30 most liquid and capitalized companies listed on the Nigerian Stock Exchange. It's a great way to invest in a basket of top Nigerian companies without buying individual shares. These funds provide a low-cost way to diversify your investments, whether you're aiming for low-risk returns or broader market exposure, all in a passive way. So, how do you actually invest in index funds? It's pretty simple. You can use brokerage accounts or investment platforms. In Nigeria, you can go through Stanbic IBTC or apps like Bamboo or Trove if you are interested in foreign market. In the UK, you've got platforms like Hargreaves Lansdown, Vanguard UK, and apps like Trading 212. The process is straightforward. For mutual funds, you invest directly through a broker or platform. For ETFs, you can buy and sell them like regular stocks on platforms such as Freetrade or eToro. But before you jump in, it's important to do your research. Look into the performance of different index funds. Compare their fees, very important, and make sure they align with your investment goals. Now, here's why index funds are such a popular option, especially for beginners or investors with a low-risk appetite. Diversification. You're not putting all your eggs in one basket. Index funds invest in a wide range of companies. Low cost, because they're passively managed, fees are generally lower than actively managed funds. Long-term growth. Index funds are ideal for investors who want to build wealth slowly and consistently over time. If you're looking for a straightforward way to invest in a variety of assets, index funds could be the perfect choice for you. Dividends payment. When you invest in an index fund, particularly one that tracks dividend-paying stocks, you will often receive dividends from the companies included in the fund. This means you're not only benefiting from the capital appreciation, the increase in the value of the stocks over time, but also from regular dividend payouts. For example, if your index fund tracks something like the S&P 500 or FTSE 100, which includes companies that pay dividends, you'll receive those dividends as part of your returns. Many investors love this because it gives them a steady stream of income, even if the stock market isn't doing particularly well. Another positive aspect is that, unlike individual stock investing, where you may have to constantly monitor for new dividend opportunities, an index fund makes it automatic. The fund collects dividends from all the companies in the index and distributes them to you. So you get the benefit of broad market exposure and dividend income, which makes index funds a great choice for passive income seekers. Index funds are a great way to start investing, especially if you're new to the world of finance or just want a low-risk way to grow your wealth. The beauty of index funds is that you don't have to be an expert stock picker. You're investing in the overall market, which historically has provided solid returns. If you're interested in my portfolio of index funds, then let me know in the comments. I'd be happy to share in future videos. And of course, I've got more content coming up about how to build your portfolio with passive income strategies, so stay tuned. Now, while index funds have plenty of benefits, they aren't without some disadvantages, and it's important to be aware of them before diving in. First, there is no flexibility. Because index funds are passively managed, they don't react to market conditions. If the market goes down, your index fund will follow. And unlike actively managed funds, there's no one picking stocks to potentially beat the market. Limited growth potential, index funds aim to match the market, not beat it. If you're looking for high returns and are willing to take on more risk, this may not be the best option for you. Index funds won't give you the chance for outsized gains that come from investing in individual stocks that may skyrocket. Market risk. Like all investments, index funds come with risk. If the market as a whole declines, so will your investment. While this is passive income in the sense that you don't need to actively manage it, it's still subject to the ups and downs of the stock market. Not for short-term investors. If you're looking for quick gains, index funds aren't designed for that. They're best suited for long-term, slow, and steady growth. Smaller dividend payout. There's a potential downside to this too. The dividend yield, that is the percentage return you earn from dividends, can often be lower with an index fund compared to individual high dividend stocks. This is because an index fund includes both dividend-paying and non-dividend-paying companies, meaning your overall dividend yield might be diluted compared to hand-picking individual stocks that have higher dividends. So, if your goal is to maximize your dividend income, you might find index funds to be less attractive than investing directly in high-yield dividend stocks, like Zenith Bank in Nigeria or British American Tobacco in the UK, which tend to offer higher payouts. While index funds are often referred to as a form of passive income, meaning you're earning money without actively working for it, it's essential to remember that they still carry market risk. You can't control the performance of the market, and while historical trends show long-term growth, there can be significant fluctuations along the way. Thanks for watching. Don't forget to hit that like button, subscribe, and turn on notifications so you don't miss out on any future updates. Remember, success is a journey, a marathon, and not a sprint. Though it may be slow, keep at it and be consistent. To your success.